What's up, y'all? As you know, Felipe here to keep you up to date with current market news, teachings, and everything tech. So today I'm going to run by you guys some interesting stuff I've fortified, not only for myself personally, but I feel like it's very prevalent now in like the current economical, financial environment, whatever you want to call this thing we are in, which is super interesting stuff to see. So I'm going to go ahead and jump right into it. So essentially, I'm just going to start off kind of explaining a couple of things. So I put this together through some research and stuff I've done, some books and all kinds of other things, and I find it super informational. So understanding a cyclical company's cost structure is critical. Companies with mostly fixed costs have little room to cut costs in a recession. The automobile industry illustrates the devastating impacts of a fixed cost structure in a highly cyclical business. Think about 2008 for example. A lot of these automobile companies essentially had all these high fixed costs they couldn't really do anything about. They couldn't change their situation, which caused them to pretty much, a lot of them almost go into bankruptcy, like Chrysler, Ford, and some other companies where the government had to step in and essentially bail them out. If you're considering investments in a gaming sector, such as casinos, you must consider the potential government to grant new licenses and the associated impact by performing due diligence, because this is going to go into kind of what I'm going to be talking about. More competition is bad. And I get it, or we get it, the government is always trying to prevent monopolies, but a saturated market with too much competition is no good for anyone. And then that causes a reduction in revenue and income and cash flow in the future for specific areas of business like niches or sectors, right? Healthcare is another heavily regulated industry. Many healthcare providers are at least somewhat dependent on Medicare and Medicaid reimbursement rates. We're seeing this literally right now. The current administration is really going after the healthcare companies, and through acts and government legislation, a lot has changed recently in the health insurance industry or healthcare industry or sector, which has caused like a lot of those company stock deployment, like United Healthcare, a bunch of them, Cigna, you name them, all of them are pretty much in a bad environment in the stock market. Their stocks have gone down quite a lot. I see that personally as opportunity, although a lot of people are afraid or fearful to get involved in these in this industry right now. I like it personally because it means you're getting more bang for your buck, although you do have to stomach the risk of the next couple of years or year or so, all these different regulatory changes are going to really affect the stock pricing in the health insurance companies. The credit cycle, which is one of the credit analysis, and capital cycle, which are kind of the topic of what I'm sharing today. The credit cycle is essentially this, super important, and if you've seen one before, you've kind of know what I'm talking about. So refers to the degree of difficulty companies have in accessing the debt markets based on changes in markets participants' appetite for risk. There's a couple of phases in this. Number one, the expansion phase. The expansion phase, leading standards become lax and access to credit is easy and cheap. Companies tend to increase leverage during this phase. The downturn phase. This phase usually begins when the economy slows down and enters a recession. Defaults increase as companies' profitability, cash flow, and debt servicing capacity are negatively impacted. As lenders deal with troubled loans, they tighten lending standards because they're losing money on those loans. A greater risk aversion leads investors to demand higher returns. More risk, more probability of return rate, resulting in a higher borrowing cost and access to debt. Capital is curtailed for all but the highest quality companies, which is kind of like what we've seen a lot of the blue chips like your Apples and all that in the current environment. Repair phase, defaults start to decline. Companies focus on cash flow generation by cutting costs and growth-oriented capital spending. Some companies take advantage of the bankruptcy process to restructure with more manageable balance sheets post Chapter 11, which is bankruptcy. And lastly, the recovery phase. At the beginning of this phase, companies direct cash flow towards debt pay down. Once they regain confidence in the economy, their growth prospects, and the ability to service their debt, they gradually return to using free cash to fund growth opportunities and payouts to shareholders. Confident the worst is behind them, lenders relax their credit standards and the debt market reopens, which allows companies to relever their balance sheets. So essentially, this is lower interest rate environment. Kind of give you a picture of what this kind of looks like. I'm just going to go over here and essentially draw it out. Hopefully it makes sense. So initially the expansion phase, right, you can look at it as a graph where it's up, right? And then the downturn phase right down, repair phase, things are starting to get better, and then the recovery phase, right? Until the cycle just repeats itself, right? Downturn phase, repair phase, and recovery phase, right? So that's essentially what it would look like if you want to picture it, right? So back to what we were talking about, credit coupons. Since loans are floating rate investments, meaning their coupon adjusts based on the underlying risk-free rate of interest, which is typically that when you hear the word risk-free rate of interest, you're talking about government bonds, right, or government securities, because they're technically risk-free because they're backed by the full faith of the U.S. government. They are more sheltered from interest rate increases. On the other hand, bonds are fixed-rate instruments. Therefore, bond prices decrease as interest rates rise. As a general rule, for every 1% increase or decrease in interest rates, a bond's price will change approximately 1% in the opposite direction for every year of duration. For example, if a bond has a duration of 4 years and interest rates increase by 1%, the bond's price will decline by approximately 4%. In its simplest terms, duration is how long it takes in years for an investor to be repaid a bond's price by the bond's total cash flow, coupon, and principal. The duration of the bond is primarily driven by its maturity. The higher the duration, and coupon, the lower the duration, because more of the total cash flows from the bond are received up front. While duration can be calculated manually, the easiest way to find duration on a bond is, for example, to use the YAS screen on Bloomberg. Bloomberg's a really good resource. What basically this means is this. So you can kind of think of bonds or the influence of interest rates on bonds like a seesaw, right? So it's my pretty cool seesaw here, right? If you remember kids' seesaws, one kid's on the one side, one kid's on the other side, it goes up and down, whatever. When bond prices are at par, parity, equality, everything is valued equally, right? However, I'm just going to write some stuff here. Let's say rates are going up. We're in an environment that for whatever reason rates are going up. Maybe speculators in the interest rate markets are driving rates up or down. Federal Reserve is tightening things up for lenders. They're increasing interest rates because they're concerned about inflation, whatever the case. So rates are going up, right? So when rates go up, typically bonds, when they're at equality, when they're pretty much at par, parity, they trade not at a discount and not at a premium. However, when rates are going up, bond prices decline. So the bond price is going to go down when rates are increasing. And these are fixed interest rates, right? That's why it is influenced this way. And typically, the more the longer the duration of that bond, let's say a 30-year bond, a long-term bond, the more interest rate sensitive it's going to be. The shorter the duration of the bond, like short-term treasuries, like 3 months, a year, they're going to be less affected by interest rates, kind of what it was explaining in the example. On the other hand, when rates go down, so for whatever reason rates are going down, right, the Federal Reserve is stimulating the economy, they're bringing interest rates down, they feel inflation is no longer a problem, or as we're seeing right now, politically influence to the Federal Reserve might potentially cause that situation. So when rates go down, bond prices increase. So bond prices go up as interest rates go down. So it's kind of like an inverse bonds work inverse to interest rates. So hopefully that kind of explains what that means. Cool. So corporate debt. Corporate debt falls into 3 risk categories. 1, investment grade. These are typically rated by rating agencies like Moody's, Standards & Poor's. They assign rates to fixed income securities, right? It would be like an A, like a B, and A and B are considered investment grade. You can think of them like grades and when you got as in school, or you get in school, right? Why they give them those grades? Because investment grade is considered low risk of default, usually issued by the largest and most stable companies or governments. 2, non-investment grades, which are a specific level of B and under, would be considered non-investment grade, which are also known as high yield or junk bonds and leverage loan credit. High risk of default, and then there's also distressed debt, high risk of default, sometimes already in bankruptcy. So companies that have issued debt where that company is in bankruptcy or in some sort of financial trouble, they're not able to meet their liabilities, they're not able to pay back their dues, the interest rate on the money they borrowed. So they would be considered distressed debt, which for specific investment strategies, that's actually a strategy investing in distressed debt. As long as you're able to figure out, hey, the tangible assets this company owns in a situation where liquidation is going to occur, it's going to more than pay off the creditors, right? Which you owning a bond or owning debt, you're a creditor. Leverage credit is also referred to as high yield, sub-investment grade, speculative grade, or junk. Non-investment grade market is further divided into 3 sub-markets. High yield bonds, which we just mentioned, are also known as junk bonds, broadly syndicated loans, private credit, and direct loans. As lenders, we would not have the chance to participate in the upside, but we have experienced meaningful impairments in the downside case. So this is kind of saying, as a shareholder, you own the stock. If the company does very well, stock prices typically are going to go up, right? Because the company, it's, beating their earnings reports, they're consistently earning more revenue in the present and in the future than they were in the past, and things like that. The stock price is going to go up, right? As a lender, as a bondholder, as a debt holder, as a creditor, it doesn't work that way. As a creditor, essentially, you just want the company to be able to meet its liabilities, being able to service its debt, pay their interest on the money they borrowed, because you as the lender, as the creditor, you receive that interest payment, right? A difference between an equity and a debt mindset, which is what we just said here. While executed recklessly, the potential upside from the change in strategy, and this goes into JCPenney 2012 when they changed their executive completely changed their strategy. Made sense for the shareholders. Why? Because if this strategy would have done well, the stock price would have gone up. who might see substantial appreciation in the stock price if it worked. However, since the company was generating sufficient cash to service its existing debt, which was trading at par, if you remember the seesaw, par is the leveling of the seesaw, there was no upside for the creditors, but substantial downside if it failed. The strategy implemented by management in 2012, which did fail, it did not end up going the way they planned. Two types of coupons, floating rates and fixed rate. Floating rate, the coupon floats, right? It can vary, kind of like what the name says, it can float. The coupon of a floating rate bond or loan floats at a spread negotiated at the time of issue to the underlying risk-free rate. As this base rate moves on, so does the coupon. Historically, the base rate for US dollar loans, was typically the London interbank offering rate, LIBOR. However, in 2020, the secured overnight funding rate, SOFR, replaced LIBOR. This is essentially the rate that central banks and major financial institutions lend to one another, and it's a floating rate. For example, if a bank debt coupon is SOFR plus 500 basis points, 500 basis points is 5%, and the SOFR is 2%, then the coupon is 7%, the 2% SOFR rate plus the 5% credit spread. If SOFR increases to 3%, the coupon rises to 8%, the 3% SOFR rate plus the 5% credit spread. Loans typically have floating rate coupons, and floating rate coupons are less interest rate sensitive than fixed rate coupons. Fixed rate, most high yield bonds are fixed rate instruments, meaning the coupon does not change with the underlying risk-free rate. This stuff, although it seems a little complex, super important to kind of get an understanding, because this is literally money. This is how money is created. This is how money is loaned. For example, when rates are high, the currency of said country, whatever country you want to place, for example, XYZ country, their government, for whatever reason, is increasing interest rates by a large amount, they're fortifying their currency. Of course, that's dependent on what the market or speculating in what that currency's value is, but for the most part, when a country is increasing their interest rates, they fortify or strengthen their currency, and vice versa. When they're reducing their interest rates, they're weakening the currency of their country. So pricing dynamics, why a debt instrument might trade below, above its issued price. So remember the seesaw thing I drew so one, the risk-free rate increases. Risk-free rate, think about the U.S. government bond. If the risk-free interest rate, example U.S. Treasury yield, increases, new debt must be issued with a higher coupon than existing debt. Investors reprice existing debt to reflect the higher yield that the market now demands. Note that this only holds true for fixed rate debt, not floating rate, since the coupon of a floating rate debt instrument adjusts with movements in the risk-free rate. 2, the overall level of credit spreads, credit risk premium in the market increases. In times of broad financial distress or economic uncertainty, such as during the Great Financial Crisis 2008, investors required a higher return credit spread for the same credit risk, because there was financial distress in that period of time. Prices must decrease so that the resultant yield reflects increased risk aversion. 3, the company's idiosyncratic risk increases. If a company underperforms expectations, the probability of default has decreased, and investors require a higher return. This is accomplished via a decrease in the price of the company's debt instrument. So company's not doing so well financially, therefore investors presume that that company's not going to be able to service its debt, Therefore, that debt becomes riskier. So that riskier debt now has to pay more interest rate in order for investors to be interested in it. Otherwise, they're not going to take that risk. The inverse of the scenario outlined above applies as well. A decrease in risk-free rate, market spread, or issuer risk reduces the yield demand by investors, and the price of the debt instrument increases with a corresponding decrease in the yield. Risk-adjusted returns. So kind of the whole topic of this is credit analysis, right? And the capital cycle, which I'll kind of go into in a second. Credit analysis involves analyzing companies to determine their risk profiles. Debt investors define risk by the probability the company will experience a payment default. Example, the company cannot pay its interest or principal when due, and the severity of loss in the event of a default, also referred to as loss given default, LGD, which is an estimate of how much of the investment will be lost if the company defaults. Because here's where you would factor in tangible assets like real estate and other tangible things that you can touch and sell, right? The inverse of LGD is recovery. That is what the investor can expect to recover in a default scenario. Again, what I just mentioned. Example, selling of tangible items or assets like real estate to be able to recover and meet those interest payments and principal payments that the company did not make. Relative value analysis compares the expected return of corporate debt investments with similar risk profile. The focus is on risk adjustment return rather than absolute return. For instance, a debt instrument trading at a 10% yield, 10% interest is not necessarily a better investment than another at 8%. If the latter investment has a lower risk profile, a critical component of credit analysts is making good risk adjustment recommendation. And the capital cycle. This is super interesting because it feels like it makes so much sense in the current environment we're in. So the idea that the prospect of higher returns would attract excessive competition has been reinforced over the years with the observation that investment bankers spend their lives flogging the latest investment fashion. So investment bankers, stockbrokers, so forth and so on are going to usually pitch what is the popular trend, what is the most popular stock right now. You got to buy this thing. If you don't buy this, you're a freaking idiot. You're going to be left behind. You know, they create the FOMO and all this stuff, and they get a lot of retail investors interested in a specific niche or area or industry or sector through creating all that hype. The responsive management to the forces of the capital cycle, in particular, whether they curtail investments when returns have been poor, has become a particular focus of attention. The capital cycle, new entrants attracted by the prospects of high return, so hot industries, the latest investment fashions, think of AI for the moment, investors optimistic, rising competitive competition causes returns to fall below the cost of capital, which cost of capital, return of capital, all those things are extremely important to a business overall. Share price underperformance, improving supply side conditions cause returns to rise above cost of capital, share price outperformance. So it's circular, as the word cycle in the capital cycle describes. The capital cycle approach to investing is based upon the principle of mean reversion, that higher returns will attract competition and vice versa until the point is reached when companies in any particular industry are, on average, earning their cost of capital. However, reversion does not occur overnight. In the real world, there would be a lag of several years between the initial observation that excess capital is being drawn into an industry and the time it takes to build new factories with that capital. Think about the data factories or data farms that these AI companies are building. The arrival of goods from those factories into the market and the companies reporting to investors how its financial results have been affected by the sale of these goods. The capital cycle approach requires investors to take a long-term view and to maintain the courage of their convictions. This creates an institutional imperative among professional investors to chase the best performing stocks, just when the capital cycle analysis suggests that they should act in the contrary. I'll give you a beautiful example of this. The current environment with AI, super overhyped. A lot of the AI tools and technologies are amazing, right? Super cool, sexy, awesome. I use them all the time. I'm pretty familiar with this stuff, and I have a good understanding of it. However, most of those companies, whether they have a division that is specialized in the AI infrastructure, or if they're just an AI company, that specific area is not making any money. In fact, this has a high cost of capital, and most companies are not earning above what that cost of capital is. In fact, companies like OpenAI, they're losing tons of money. They don't make any money, yet they're able to survive because investors are pretty much giving them the money so they can continue to operate. On the other hand, the health insurance industry, right, for example, has this just ugly environment surrounding it. Government regulatory pressures, legislative pressures, and not even that, the image of the industry is very negative right now, as we saw with the United Healthcare CEO assassination and all that stuff. People just really don't like the health insurance industry or sector right now. To me, that creates opportunity, because the less attention is getting, it means most likely the stock prices are going to be depressed. So this is kind of an example of what that kind of this last piece here means. This creates an institutional imperative among professional investors to chase the best performing sectors, AI, just when the capital cycle analysis suggests they should act in the contrary manner. Health insurance industry. So I give you an example of that. Security analysis. I actually got this from the security analysis book. The dean of Wall Street, as they used to call him, Benjamin Graham, and David Dodd. So in this book, he specifically states something that is similar to the capital cycle. A business which sells at a premium does so because it earns a large return on capital. This large return attracts competition and, generally speaking, is not likely to continue indefinitely. Conversely, in the case of a business selling at a large discount because of abnormally low earnings, the absence of new competition, the withdrawal of old competition from the field, and other natural economic forces should tend eventually to improve the situation and restore a normal rate of profit and investment. Nevertheless, investors who seek to use the capital cycle analysis to identify investment opportunities must take care not to apply it naively. It's difficult to do so. Graham and Dodd warned against investing solely on the basis of changes in the capital stock of an industry. We doubt, they wrote, if it applies with sufficient certainty and celerity to make it useful as a governing factor in common stock selection, but something you should simply be aware of. Some history here before I close this off. Asian financial crisis 1998, the collapse of the baht, which was the Thailand currency, quickly spilled over to other parts of East Asia, especially the Philippines, Malaysia, South Korea, and Indonesia, all of which had foreign debt to GDP ratios, high foreign debt to GDP ratios. By early 1998, those frontline currencies had devalued by nearly half, triggering substantial asset deflation and plummeting stock prices and property values. They became known as the Asian financial crisis. So a collapsing currency for a country is not a good thing sometimes for stock prices, as you can see. 1982, the personal computer boom, the year in which Time Magazine declared the PC as its Man of the Year, and dozens of computer disk drive companies went public. boom had turned to bust. The computer industry failed in the early 1980s not because the future of information technology was dim, as we can see with hindsight. It's changed everything, right? On the contrary, the prospects for growth were very bright. It failed simply because in those early days there was simply too much competition. Think how this might apply today. To me, this seems like it could potentially apply in some ways. 1890s, by the early 1890s, half of the railway companies in the US were in receivership, basically bankruptcy, subsidized by the US government due to overbuilding. Industrial consolidation was the means used by these businessmen to improve returns. Industrial consolidation is actually a good thing, although government doesn't like it because they call it monopolies, and kind of that's what they can become, right? But industrial consolidation typically refers to a mature industry that has had years and years to figure out what they were doing wrong, what works, and kind of get their stuff together. Some quotes here. It's not my strong view that while they may not know what lies ahead, investors can enhance their likelihood of success if they base their actions on a sense of where the market stands in its cycle. That would be the credit cycle, for example. Cycles will never stop occurring if there was such a thing as a completely efficient market, and if people really made decisions in a calculated and unemotional manner, perhaps cycles, or at least their extremes, would be banished. But that will never be the case, and these are by Howard Marks. The benefit of reduced competition were understood by the 19th century tycoons such as Morgan, J.P. Morgan, and Rockefeller. So there you go. There's some things I want to run by you guys. Let me know what you think. Let me know if you find it as a valuable source of information, or if you have different thoughts or feelings about what I've shared with you. Just let me know. All right. Talk to you guys on the next one. Have a good one.